In this video, we'll walk you through the input adjustments of the Databook as if we're evaluating an actual company. We recommend that you have a copy of the Databook opened as well for better reference. We'll start by making adjustments on the company's EBITDA, which is in the Quality of Earnings tab. Let's imagine the selling company's management team identified some accounts that need to be added back that would better accurately reflect the company's true financial performance. In the context of EBITDA, adding back these accounts in our adjustments essentially exclude them in the EBITDA calculation. Let's go back to the Quality of Earnings tab, wherein we'll find the management adjustments. To make these adjustments, simply click the drop-down menu, pick the relevant account names provided by the management team. You could also just type in a few letters into the cell to filter out the list. As a demonstration, we'll type in the first few letters for interest income, then you can see the filtered list. Then simply select interest income. Numbers from the actual financials will then be populated automatically for the respective periods. You can do this for the rest of the accounts as shown here. Do note that the respective account names should remain as is to prevent causing output errors. Just below the input array, you'll find the management adjusted EBITDA for each period. On top of the management adjusted EBITDA, there are also some non-recurring expenses that we've identified that needs to be added back. These are share listing expense, legal and professional fees incurred for IPO. Like what we did before, we simply select the relevant accounts in the drop-down, this time under Diligence Adjustments, to have the numbers reflected in our input cells. Below, you can see the Diligence-Adjusted EBITDA for the respective periods. The rightmost part, you'll find the figures in annual form. And also the last 12 months or LTM figures from the latest reporting period. In this case, is June 2024. For better visualization of the adjustments, you can refer to the Quality of Earnings overview under the Graphs tab. You can see how Adjusted EBITDA is more normalized given that we excluded the one-off transactions, especially for January 2022 to April 2022. This gives us a better and more accurate representation of the company's operating income by excluding non-recurring transactions. Just below is the Adjusted EBITDA waterfall, illustrating the changes in EBITDA from 2022 to the last 12 months, LTM, ending June 2024. Let's now take a look at net working capital. Before we proceed to the numbers, do note that, at default, the adjustment logics for net working capital is the same with the Quality of Earnings. In the next example, we'll show you how to make manual adjustments, which is useful when we only want to exclude partial amount of an account. Continuing our case, we've identified some non-recurring payroll or short-term accrued employee expenses during the due diligence process. We don't want to exclude them entirely, but rather we determined that partial amount should be excluded from January 2022 to August 2022 given some non-recurring transactions were done back then. To account for this, find the relevant account from the drop-down list, in this case, short-term accrued employee expenses. Then simply remove the formula in place and manually input the amount from your list for the respective period. And that's it, you can now see the adjusted net working capital for the respective period. And just below the input array, is the recasted net working capital which accounts for the diligence adjustments we made above. In this case, short-term accrued employee expenses, which is under accrued expenses, hence, you can see the amount was reduced by the respective amounts. Referring back to the graphs, under net working capital analysis, this can be interpreted as, the company consistently operates with a negative net working capital, which can indicate short-term liquidity constraints, potentially relying on short-term financing to fund operations. The last 12-month average net working capital analysis shows that the recent 3-month average net working capital is worse than the longer-term averages, implying that short-term liquidity could have deteriorated compared to the earlier part of the year. We hope this walkthrough gives you more insight to use the tool more effectively. Keep an eye out for future updates as we continue improving and adding new features to make your due diligence experience even smoother. Thank you for watching.